Hi everyone. This is going to be our chapter 10 practice, and you'll notice that there is only one version. There is not a practice A and a practice B. There is just one chapter 10 practice. So let's get started. Our first one is dealing with depreciation. And it says a machine costing $215,800 with a 4-year life and an estimated $19,000 salvage value is installed in Luther Company's factory on January 1st. The factory manager estimates the machine will produce 492,000 units of product during its life. It actually produces the following units: 122,000 in year 1, 123,200 in year 2, 121,000 in year 3, and 135,800 in year 4. The total number of units produced by the end of year 4 exceeds the original estimate. This difference was not predicted. So that last couple bits of information where they tell us the actual units, that's going to be used only in the units of production. We don't need that information for straight line or double declining balance. So the first thing says to compute the depreciation for each year and the total depreciation for all years under each depreciation method. So we're going to look at straight line depreciation first. And a straight line, remember, we did that way back in chapter 3, and we learned that it is the cost minus the salvage value divided by the useful life gives you the annual depreciation expense. And then every year, it's going to be exactly the same under straight line because straight line is going to have the same amount every year. It's consistent from one year to the next. All right, so let's pull up the calculator and we're going to show you the calculations that we need to do. Okay, so it tells us that we have a cost of $215,800. We're going to subtract the salvage value of $19,000, and that's going to give us $196,800. We divide that by the useful years, the useful life in years, and we get 4 years. So we are going to depreciate $49,200 for each year. Remember, with straight line, it's the same every year. So for year 1, it is $49,200. For year 2, it is $49,200. Year 3 and 4, same thing. It's not going to change from one year to the next with straight line depreciation. So we see here that we get a total of $196,800. I'm going to hit check my work so that you can see that it is correct. It does show that it's not complete because we still need to do the units of production and the double declining balance. So now let's move on to the units of production. This one, that's where we need those pieces of information from the top where it tells us how many units we use in each year. So this time we're still going to be doing a formula where we're going to take the cost minus the salvage value. So the cost of $215,800 minus the salvage value of $19,000. But for units of production, instead, we're dividing it by the number of useful units. Well, they told us that they expect the machine to produce 492,000 units. So we divide that by 492,000, and we get 40 cents per unit. So our depreciation per unit is 40 cents per unit, and that is going to be the same for each year. Then we're going to enter in those depreciable units. So in year 1, they said that we had 122,000. In year 2, it was 123,200. In year 3, it was 121. And then the last year, remember it said that it exceeded the original estimate. Well, we can't depreciate below that salvage value. So what we have to look at now is if we had 492,000 that we were allowed to depreciate, how many have we depreciated so far and what are we allowed to depreciate left? So year 1 was 122,000. Year 2 was 123,200. And year 3 was 121,000. So we have 125,800 that we can depreciate. So 125,800, that's the depreciable units because we cannot depreciate more than the 492,000 units they told us to start with. So now we're going to multiply each of the depreciable units times the depreciation per unit to get that amount. So we have 122,000 for the first year times 40 cents per unit, and that's going to give us depreciation expense of 48,800. Then we're going to go to year 2. Year 2, we have 123,200 times 40 cents per unit, and we have 49,280. For year 3, we have 121,000 times 40 cents per unit, and that gives us 48,400. And then for year 4, we're going to do the same thing, except we're using the depreciable units again. Don't forget, 125,800 times 40 cents per unit, and that gives us a total amount of 50,320 that we are going to depreciate. It adds the total amount up for us. Again, we don't want to exceed the 492,000 units, and this is going to be our total depreciation expense for all 4 years. All right, let's go on to the double declining balance now. All right, so our double declining balance. This is where we're doing double the straight line rate. So what we're going to see is we're going to calculate a percentage of the straight line of how much are we depreciating every year. And the way we do that is we take 1 divided by the number of useful life. So then 1 divided by 4 in this case. So if we take 1 divided by 4, we are depreciating 25% in the straight line method. Well, this is double declining balance. So we're going to take that straight line method, 25% times 2, and we're going to depreciate 50% every year. So that's what I'm going to enter in here as the depreciation rate. We are just depreciating 50% each year. And the last year we may have to plug in a number because we can only go so far. Okay, so once we get our depreciation rate and we had that 50%, the first thing we have to remember is that double declining balance is actually going to be based off of the beginning period book value. So we have to have that for every period. So we can't just list each of the values every year. We need that ending book value from year 1 to go into the beginning book value for year 2. So we're going to start with our beginning cost, which is $215,800. That is our beginning period book value. So then we multiply times that 50% rate, and that's going to give us our depreciation expense. So we're going to take $215,800 times 0.50, and we're going to get $107,900. So that's how much we are depreciating in year 1. It's going to show you our total accumulated depreciation is now matching our depreciation expense for year 1, because since it's the first year, that's all that has accumulated. But we're going to see as we depreciate other years that accumulated depreciation is going to increase. So when the accumulated depreciation increases, we see the book value decline by how much we depreciated. So the end of year 1 book value is $107,900. That's going to be our beginning amount for our second year, so $107,900. And then again, we're multiplying that times 50%, and we're going to depreciate $53,950 for year 2, which is going to be added to what we depreciated the prior year to give us a total accumulated depreciation of $161,850, which brings our book value down to $53,950. We're going to enter that in as our beginning period for year 3, $53,950, and we're then going to depreciate 50% of that. That's going to be $26,975, and that's going to give us a total accumulated depreciation of $188,825. And that comes from adding these 3 numbers of depreciation expense all together. That gives us the total amount we've accumulated for depreciation. Our book value decreases by the amount that we depreciated. So we had a book value of $53,950. We depreciated $26,975. That brought us down to $26,975. Now year 4, that's where we get to this different place, because what we're doing is we would normally calculate that 50%. So let's see what that comes out to. It's going to be $13,487.50. So let's plug that in and I'll show you what it does. What's the number again? $13,487. All right, but you'll notice that depreciates the book value to below our salvage rate, which we don't want to do. So in the last year, we are using what we call a plug-in number. We're not going to depreciate based on that 50%. We're going to figure out how much is left to depreciate. Well, up here it told us that we had a salvage value of $19,000. So that's the lowest we want to see this book value. So if we look here, we have $26,975. We subtract 19,000 because it's the lowest we want to see our book value. That's what we're going to be selling it for. Remember, that's our salvage value. And that's $79.75. So we're going to use what we call a plug-in number here, and that's what we're going to depreciate for year 4. So 7975 is what I'm going to enter. And you'll see that that brings our total accumulated depreciation and our total depreciation expense to that cost minus the salvage value, which we calculated in the other ones, and we got $196,800. Our book value should equal our salvage value, and that's what we want to see. So I'm going to hit check my work to show you that that's what we should be doing, and you're going to see that that's what we're doing. So one thing to remember, we have to put in the book value at the end of year 1 into the beginning of year 2, and we're going to continue to do that for each year. That last year, it's a plug-in number. We're often not multiplying these two numbers. You're going to enter it in as such, but you're going to be using whatever year 3 minus the salvage value as your plug-in number, because you want that ending book value to be the salvage value. All right, so now we're moving on to question 2. Question 2 gives us a calculation to record the cost of the machine. So for this one, what we're looking for is what is included in the total cost. And we have to remember, some things are included in the cost, some things will be expensed. So let's take a look at this one. So obviously the price we pay for the machine, or the purchase price, is going to be included. So we see an invoice price of the machine of $12,500. Then we're going to subtract out the discount that they're giving us, because it tells us here, Rizzio Company purchased a machine for $12,500. Terms are 2% 10, net 60. So they're giving us a 2% discount if we pay it within 10 days, which we're going to. It also tells us that it's FOB shipping point, which means it changes the ownership to us, the buyer, at that shipping point. So when it leaves their shipping point, it's our responsibility, which means those transportation costs are also responsible for the buyer, us. So it says Rizzio paid within the discount period and took the $250 discount. So we're subtracting out a $250 discount here, which gives us a net purchase price of $12,250. Then we're going to add in our other costs, which it tells us we have transportation costs of $360 that were paid by us. The machine required mounting and power connections costing $895. Another $475 is paid to assemble the machine, and $40 of materials are used to get it into operation. Then it tells us that during installation, the machine was damaged and $180 worth of repairs were made. Well, here's what we have to remember. With this situation, we have to remember that it is only the things that are getting it ready for its use. So when we think about the things that are getting it ready for its use, the transportation costs to get it to us, so those are going to be included, and that was $360. It's going to add to our price. It says required mounting and power connections. So mounting and power connections, that's getting it ready for use. So we are going to include that. That was $895. And then we had assembly cost. So assembly, which was $475. And then we have materials to get it into use, and that was $40. The last one, it says during installation the machine was damaged and $180 worth of repairs were made. Well, that's not part of getting it ready for business. That was a mistake that someone made, so that $180 would be expensed. We would not be adding that to the cost of our machine. That would be an expense we have to recognize as a repairs expense. So I'm going to hit check my work to show you the calculations. Make sure you have all the same numbers. Our total cost is going to be $14,020. All right, this video is going to stop here, and we'll continue on with number 3 in our next video.